Hello everyone and welcome to episode 46 of JustDario Cigar Time. There are so many critical developments demanding our attention right now, but I will start with the elephant in the room, the US government shutdown that kicked off this week. I will then follow with a necessary update on the state of the AI bubble and then conclude with the most important topic this week, gold, signaling a tectonic shift is likely underway in the global financial and monetary system. Before diving in, if you want to support my channel and my work, please don't forget to like the video, subscribe, and turn on the notifications not to miss my future updates. This US shutdown is not just another political squabble. It's a potential powder keg for the financial markets and the broader economy. According to the latest odds on Polymarket, the prediction market darling for gauging real-time sentiment, there is a 46% probability that this shutdown drags until or beyond the 15th of October. These aren't just numbers on a screen. They are a barometer of investor anxiety baked into everything from treasury yields to equity futures. Now, why does this matter so much? As I laid out in my article earlier this week, no one will care about a US shutdown unless it sparks a bank run. Go to check it out if you haven't. First shutdown is mostly noise, a blip that markets shrug off with a yawn. But if this thing stretches into 2 weeks or beyond, we are talking real trouble. History isn't kind here. Remember the 2018-2019 shutdown? It lasted 35 days, the longest on record. And it wasn't just furlough workers feeling the pinch. Delayed payments rippled through the system, hammering small businesses, stalling economic data releases, contributing to a brief spike in unemployment claims, and even hurting the liquidity of the money market system, culminating in the repo crisis in September 2019. A prolonged 2025 shutdown could ignite something far uglier this time, a full-blown banking crisis. We are already skating on thin ice with commercial real estate loans soaring at a 10% delinquency rate as of Q2 2025, and household debt hitting $17.8 trillion, the highest ever. If federal payments halt, think Social Security checks, contractor invoices, or even IRS refund processing, banks could face a cascade of withdrawals and defaults. We would need another massive central bank intervention, similar to the 2023 Bank Term Funding Program that pumped $2 trillion into the system, or the 2019 repo market rescue, where the Fed injected $250 billion overnight. And let's not sugarcoat it. The scale of the crisis this time could dwarf 2008. Back then, the great financial crisis saw $14 trillion in global write-downs and a 50% S&P 500 plunge. Today, with derivatives exposures at $600 trillion notional value, up 20% since 2020, a shutdown-triggered liquidity crunch could unravel the whole shebang. The best real-time indicator of incoming stress in the money market system might be the quick evaporation of the quote-unquote cash on the sidelines parked in the Federal Reserve reverse repo facility that closed down to roughly $8.4 billion on Thursday, and that this pace might hit zero next week. Another good indicator of incoming troubles in the banking system is the amount of banks' reserves held at the Fed that, as expected, deteriorated again this week, falling below roughly $3 trillion and closer to the level when the US regional bank crisis started in 2023. Be aware, the bubble is much larger today and the system more leveraged, while reserves are at the same level. Surely not encouraging. Let's now talk about the AI frenzy that's sucking in more oxygen by the day. This isn't some fringe tech play anymore. It's the reigning narrative, propping up mega caps and turning boardrooms into sci-fi conventions. But peel back the glossy headlines and you'll see cracks wider than the Grand Canyon. Take OpenAI, the poster child of this mania. Just this week, the company's valuation rocketed to $500 billion following the secondary share sales, where former and current employees offloaded $6.6 billion worth of stock to a consortium of private investors, led, unsurprisingly, by SoftBank. Don't let mainstream media spin fool you. This wasn't a fresh capital raise to fuel operations or offset that voracious cash burn OpenAI as. No, it was a straight up liquidity event for insiders cashing out. My take, simple and stark. Why the hell are these folks so eager to dump shares en masse if the story they are peddling is gospel? You have got Sam Altman and his cheer squad hammering non-stop that AI is a multi-trillion-dollar revenue gusher, with OpenAI poised to be the crown jewel at $10 trillion or more by 2030. Yet, here they are, insiders unloading billions. Sure, might sell a silver for a yacht or a family vacation. Personal liquidity makes sense, but $6.6 billion? That's not diversification. That's a vote of no confidence from the very people building the damn thing. This distrust isn't isolated. Dig into the numbers, and the skepticism multiplies. OpenAI's enterprise adoption is stalling. While ChatGPT has roughly 200 million weekly users, paid subscriptions over just 20 million, out of which only 5 million are corporate, generating under $9 billion annually, according to internal leaks reported by media that I suggest taking with a grain of salt. Meanwhile, the cost to train models like GPT-5 is ballooning. Insiders know the reality is far different from what it's being portrayed to the public. They are not buying the infinite upside fairy tale. Then there is this week other headline grabber. Microsoft doubling down on its AI infrastructure bets with a massive expansion of its deal with Nebius, the upstart neocloud provider. The agreement now totals over $17.4 billion in multi-year commitment, expandable to $19.4 billion, part of Microsoft's broader $33 billion pledge to third-party AI cloud outfits like Nebius, CoreWave, and Lambda. On paper, it's a masterstroke, outsourcing GPU hunger to nimble players who can scale faster than hyperscalers themselves. But let's call it with what it is, a desperate circle of financing dressed up as partnerships. New clouds, they are ghosts with big dream but no war chest. Nebius, for instance, just announced a $3 billion raise to fuel growth, hot on the heels of this Microsoft pact. But they are starting from scratch on infrastructure, with the only New Jersey data center in the US not even completed yet. No owned data centers, no proprietary fiber networks, just MOUs and letter of intent that sound sexy in press releases but evaporate under scrutiny. NVIDIA CEO Jensen Huang warned in their last earnings call that AI supply chain is strained, with global GPU demand outstripping production by 2 times. Yet, these deals keep dropping like confetti, each one engineered to pump the narrative. AI is unstoppable, pouring more. It's brainwashing one-on-one, folks. Every MOU prop up stock prices, quiets the doubters, and keeps the faithful from dumping shares at nosebleed valuations. Look at that Magnificent 7. NVIDIA trades at 60 times forward earnings, up from 30 times a year ago. Microsoft PE is 38, pricing in flawless execution on a $100 billion AI runaway that's more hope than hard orders. But where's the beef? Enterprise AI spend is projected at $430 billion globally in 2025. But that's spread thin, mostly pilots, not production. McKinsey estimates $5.2 trillion in capex just for AI-equipped data center to 2030, with hyperscalers like Meta planning 60 to 65 billion in 2025 alone. But that's not growth. That's a bottomless black hole. And the revenue mirage? Forget it. Adoption curves are flattening. Gartner forecasts global AI spending hitting $1.5 trillion in 2025. Infrastructure alone takes most of it, leaving crumbs for software. Customers aren't biting like lemmings. If you're shelling out $100,000 a month for Azure, are you doubling down to $200,000 a month for some LLM wrapper? Hell no. You are negotiating bundles or switching. Microsoft Copilot is basically free add-on for Office 365 subscribers, and Perplexity just axed its $200 a month pro tier to lure users. The pricing power is a myth. It's commoditizing faster than expected. All right, before we barrel into gold, I've got to share this pearl from a friend that hit me like a freight train this week. Spot on, no notes. He said, Dario, consider Meta's metaverse debacle. They were hemorrhaging billions, $36 billion in losses from 2021 to 2023 per their own filings on VR headset and blockchain fever dreams. As long as the stock kept climbing 40% year-to-date in 2021, they could claim investor buy-in. But then reality beat. Revenues flatlined at $117 billion in 2022, while capex exploded 50%. Crypto winter in 2022 crushed NFTs values, and FTX implosions wiped out $8 billion in equity value overnight. Investors bailed, shares cratered 70% from all-time highs, and suddenly the narrative flipped. Metaverse? What metaverse? Meta slashed 11,000 jobs, wrote off $40 billion in investments, and pivoted to, well, whatever the reals is. The lesson? Hype buys time, but no revenue means no mercy. Nail on the head, right? Fast forward to AI 2025 and it's deja vu, but on steroids. Not one rogue company, but the Mag 7 all-in, splurging $500 billion in aggregate capex last year alone with no meaningful revenue delta yet. Alphabet Clouds grew 29% year-on-year in Q2, but AI-specific contribution, a rounding error at $2 billion. Amazon's AWS added $25 billion quarterly, yet generative AI pilots convert to paid at under 20%, internal doc revealed. This behemoth claimed $2.5 trillion more is needed to make AI profitable. But who's footing that? Their balance sheet, cash is quickly running out. Equity markets, dreamers gonna dream. This is through $50 billion at AI in the first half of 2025, but dilution is a killer. Debt, here is the rub. Lenders aren't charity cases. Oracle just floated $18 billion in bonds, the second largest investment-grade sale of 2025, across tranches up to 40 years, meant to bankroll their $300 billion OpenAI cloud pact through 2030. But the market sniffed weakness. Shares dipped 4% post-announcement, erasing $20 billion in market cap as investors priced in margin erosions from 35% to sub-30%. Free cash flow is already negative at $1.2 billion the last quarter, and this debt services at 5.5% average coupon. My response to my friend, you are dead right, but watch the end game. Equity loves lottery tickets. Debt demands receipts. These titans will leverage legacy operations to the hilt. Think Microsoft's $75 billion capex guidance for full year 2026. Squeezing EPS growth from 15% to 8%. Margins shrink, multiples compress, and poof, the dream funds itself into oblivion. Enter the NeoCloud shell game. Those Microsoft Nebius deals, not direct balance sheet hits. It's off-balance sheet magic. Commit billions in quote-unquote capacity reservations. Round trip via vendor financing, and voila, inflated top-line revenues without the debt sting. Nebius raises $3 billion equity, builds on Microsoft dime, and both tout AI leadership. But it's fragile. If GPUs allocate short or utilization flops below 60%, write-downs looms. Projections from 2022 promised $1 trillion in AI services revenues by 2030, but we're just a $20 billion run rate, miles off. Usage peaked in Q4 2024. ChatGPT queries are flat year-on-year now. Customers overestimated budget by more than twice. Enterprises allocate 5 to 7% of IT spends to AI, but return on investments is elusive. 40% of pilots are abandoned after 6 months for lack of value, Deloitte surveys reported. No one's doubling cloud bills without savings. It's free riders or bust. Perplexity's fee scrap, Google's Gemini back into search. Pricing power, non-existent already. This Ponzi lasts on cash recirculation, but finite dollars mean a Meta-style plug pool. $500 billion in write-downs, shares halved, legacies damaged. Phew. That's all for the AI circus for you today. Exhausting, isn't it? But let's close with something brighter, or at least more grounded. Gold. In a world of digital smoke and mirrors, this ancient metals is making a comeback that's impossible to ignore now. More folks are waking up to the economic sleight of hand. Inflation eroding savings, government deficit ballooning, and fiat currencies stretched thin. Year to date, 2025, gold is the undisputed champ among major assets. Spot gold prices surged 45% through September, outpacing the S&P 500 15% year-to-date gains by a mile. Rewind to 2020 and the tectonic shift sharpens. Gold's total return clocks at 160%, trouncing the S&P 500 105%. That's not luck, it's logic. Stocks ballooned on $9 trillion in Fed QE since March 2020, inflating multiples to 22 times earnings, while the historical leverage was 16 times. Gold, no such steroids. It's up 115% from $1,800 since late 2022, pounding at 18% annually in the recent 5 years. Why now? Inflation is the thief in the night. Globally, gold laps all of them. In China, SSE composites mired 30% below 2015 all-time highs, up a measly 5% since 2020 amid property busts and trade wars, while gold renminbi price climbed 120%. Beijing Central Bank is hoarding. Central Bank added 23 tons in Q1 2025 alone. Inflow to gold ETFs hit $2.3 billion equivalents in China at record highs. Retail is fleeing stocks for safe havens. Survey shows 45% allocating to gold in 2025, up from 25% in 2023. This shift is percolating. Media is late to the party, but retail has been piling in all along. GLD ETFs inflows at $15 billion year to date are twice the level of 2024. Are we at an inflection point? Arguably, yes. With US debt hovering at 130% of GDP, M2 money supply up 40% since 2020, and BRICS de-dollarizing with gold reserves up 25% year-to-date alone, with gold supply fixed at 3,000 tons annually mine output, things can only continue going higher and higher here. Silver is next, with industrial demand exploding for EVs. Platinum and palladium, niche plays, but commodities broadly beacon. The stock market is a fan house mirror. 1% of Americans own 50% of equities, while inflation guts the rest. Median net worth is stagnant at $192,000 since 2019. Yes, nominal wages might be up 20% in the same period, but purchasing power is flat. We are at the cusp. Hard assets as inflation shields, potentially exponential post-inflection. Governments won't quit the printing press. Deficit unchecked. Wars raging. So fiat debasement accelerates. Gold could eclipse reserves. Central banks already hold 36,000 tons, up from 15% in 2020 against 20% today. For normies, it's portfolio armor. Hard assets rule. This fiat farce is distorting since Volcker's 1980s hikes and might crumble sooner than many people expect. Stocks is a skewed casino for the elite, but gold is the people's edge. Thanks a lot for listening to my podcast again today, for supporting me on X, on Instagram, and for reading my research on JustDario.com. I wish everyone a nice week.